Ladies and gentlemen, Excellencies, welcome. Will markets survive? The title of our panel is expansive. There's a long draft, but we'll go with the top line. Will markets survive a $100 trillion debt crisis? I think we've got to define what scale of crisis or debt mountain we're facing. And let's kick it off with you. Is it a crisis or a debt surge? How would you define it?
Well, I think that the trajectory that we are currently on, particularly in the US, but in other developed economies, towards $100 trillion of global debt outstanding is unsustainable. It is relative to where we are going to be. We could see that 100% of GDP of the economies of the globe be reached in debt levels by 2030, which isn't very far away. So assuming nothing else changes, which we know these are complex economies and backgrounds and settings, but assuming nothing else changes, that's a predominantly unsustainable trajectory.
Michal, put some context around it for us. How would you define the scope?
Well, I think that 100 trillion is clearly an ominous number, but it's also very nuanced. Two-thirds of that number can be traced to three countries. The US at 35 trillion, followed by China and Japan. And then you got to double click even further and say, okay, there are certain countries which are more likely to default. And just given their scale and their impact, it would be less so on the world stage. Whereas other countries, like the US, contributing 35 trillion, is less likely to default. Some would say will not default. And as we all know, when the US sneezes, putting on record, but you know the expression, when the US sneezes, the world catches a cold. And so I would say that you got to put that in the context. And so we did talk about the US, whether the US, how is the US faring? Today, the dollar does serve as a reserve currency. We're also sitting in an environment where we have oversupply of savings. Capital markets are functioning. 2024 finished with a record issuance of investment-grade bonds, $1.5 trillion of issuance. So investment grade is healthy. Non-investment grade is functioning. Record refinancings. And so there is adequate funding to support the debt today. But I do agree with Anne that it is the trajectory that we are on is not sustainable with implications.
We're on a fast highway, fiscally speaking. Uncle, good morning. How would you define context, first of all, crisis or manageable surge?
It's manageable surge, right? I think the way to put it is this, right? When you increase leverage, you have to be more careful. And what we have is more leverage in the economy, right? It is concentrated in the US and China and also Japan. I think the difference is that the US is the main major economy where there is no prospect for a stabilization of the debt to GDP ratio in the next several years. And so this is an issue that needs to be handled. It's not going to be easy. The US needs to cut its deficit by around 3 points of GDP to stabilize the debt. And that's the challenge.
Well, here's the issue. Ray Dalio was speaking about this very issue just 10 days ago. And he said, leave it to Ray, we're in a debt-death spiral. And of course, he's talking about the servicing of that debt, the amount of debt that needs to be rolled over here in the United States. I mean, that's a very dramatic statement, debt-death spiral. And is it as bad as that?
Well, shout out to Ray. He's a really deep thinker, and I have to commend him for bringing the issue to everyone's attention. We could be. This is actually what Keynes wrote about, and I would say particularly again in the US, we've been on a Keynesian use of the economy from our, I'm going to call them spendocrats in Washington, not realizing that when Keynes talked about stimulating economies, the idea was that when economies go through recession, then the idea is to spend to support the economy. But the part that they forget about in Washington is you're supposed to stop spending when the economy gets to a stronger point. We are spending $2 trillion a year in deficit spending in an economy with a 4% unemployment rate and a very strong backdrop. So this is where the real problem gets in, and because the cost of that debt to Ray's point, has risen so much, the cost of servicing that debt just adds on. So again, this is not a model that's supposed to work, and Keynes would probably be spinning in his grave right about now.
But then, Angel, let's extrapolate from what Anne just said. That is what Doge and Scott Bessent have very clearly said, that they have an ambition. 3% of a fiscal deficit, a Doge group that is on fire at the moment. Is that what the bond market believes? Are we giving enough pricing to Doge and deficit reduction?
Well, I think the bond market is giving it the benefit of the doubt, but it will want to see the action, right? I'll say this. To cut the deficit by 3 percentage points, which is what you need to achieve the 3% deficit objective that Scott Bessent is looking at, you need to raise revenues. You cannot do it just with the spending cuts. Unless you want to go into entitlements, you are never going to get there, because you would need to basically cut 100% of non-defense discretionary spending. So you need revenues. The question is, where are those revenues going to come from?
Well, where do you think those revenues will come from? When would you say the bond market will call success or really question this program?
I don't think the bond market necessarily is going to focus on the 3% specifically. I think the bond market wants to see a framework that is credible. At the end of the day, it's credibility of the institutions what keeps the bond markets in good shape. So a fiscal framework and credibility of monetary policy. And if that stays there, then I think we are going to be okay.
You've been on the road talking to a lot of clients. Do clients believe in this story? Is that what they're hanging their hat on at the moment when you're talking to the clients? Do they believe that from the bond perspective?
Before I answer that, I do want to say that there's the flip side of fiscal discipline, which is pro-growth policies, which we are seeing. So the other side of the equation is not just kind of cut your way to reducing your debt, but if you can put, because not all debt is bad, is where are you putting those investments? Are those pro-growth? Is it going to go towards some of the long-term projects that are going to drive automation, energy transition, infrastructure, all the topics that we've been talking about? So if you are going to grow, or you're going to get more productive through technology, the digital disruption that we've been talking about, I do think that you have a path toward that reduction. Again, not at the expense of the discipline that we need. But you asked me a different question, which is, what are the conversations that we're having? It's interesting. In speaking with clients, the topic that come up are, what is going to be the new administration's policy toward trade, tariffs, immigration, some of the geopolitical risk, and less about the deficit itself. Deficit comes into play as it relates to what is going to be the price of the debt. And I think that's the part where clients are thinking, if you have a long-term project, how do you think about funding that long-term project where duration and tenor come into the conversation to ensure that the funding and credit that you need will be there for the duration of the investment cycle.
Can we just step back for a moment, because Japan survived for, Anne corrected me this morning, it wasn't just a decade, it survived very well for 2 decades, with a high debt to GDP ratio, some fiscal issues around that. So it survived very well. Just as we look at global risk at the moment, how do you assess that? Because it seems as if we're in a pretty turbulent time. We've got to understand what the trade and the tariffs are. We need to understand where we are with global growth and disruption. And give me your risk perspective from a helicopter view, and what role do bonds play in that?
Well, so a couple of things, and I also actually like to respond to the question about revenues as well. So from a top-down perspective, the bond market can be and has in the past played a very significant role. After all, if there's no confidence in an issuer, and whether that's a company or a sovereign, then the bond market is not going to play. They're not going to participate. And so at the ultimate end of the day, the biggest risk to issuers is that there is no buyer. Currently, that's not the case, because there's still a huge amount of liquidity still in the system post-COVID from all the money pushed into the system through various central bank interventions and fiscal interventions. One of the reasons that we're here where we are is because of all of that. And there's still that excess liquidity that's there to buy those debt issuances. But I'm going to go back to the question about revenues for a moment, because if you think about a corporate issuer, companies can sort of dial up revenues, dial down costs, and they can use those tools together. historically, if you look particularly at the US, revenues have run about 20% of GDP for the fiscal coffers. Whether it's in good times or bad times, it's awfully hard to dial up the revenues. Yes, growth is going to help with that, which is obviously one of the reasons that President Trump comes to places like here and talks about investing in America, because he's trying to get the growth to come along with it. But it's a lot harder for those tools to exist for sovereigns relative to, say, a company.
Ankle, your perspective, I mean, and I know you wanted to respond on the revenue side, but Ankle, if we look at where we are, I said to you, define what success is. This bond market is very well behaved at the moment, relative to some other moments of history and crisis in bond markets. Why are we so restrained? Why are we trading 430, 470? Why is the US bond market behaving so well when we have so many unknowns on the inflation and on the policy side?
So here is one easy way to look at it if you want, right? The 10-year rate at 4.5 is the sum of 2.5 inflation and 2% real, right? So for as long as we continue to believe that the 2% inflation objective is going to be respected, the 2.5, 2.75 maybe of inflation is going to be the top. And so the other part is the real. The real can move for two reasons, the good and the bad. The good reason is we generate more growth, and then the real rate is going to go higher. So you can have a 5% 10-year rate for the right reasons, or you can have a 5% 10-year rate for the wrong reasons. That is, we start putting risk premium into the real part because the fiscal framework is not credible. I'll give you an example. Where are the revenues going to come from? Tariff revenue is not sustainable because it sows the seed of its own destruction, right? You put tariffs up, trade is going to come down at some point. So you can calculate how many dollars are going to come this year, but not necessarily over the next 10 years, right? So that's part of the discussion that I think the bond market is going to be having over the next several months.
And this concern about growth, I mean, this is not just a US concern. We're at just over 2% at the moment. The view is that it may just settle a little bit lower. We've got to see what the extension of the tax cuts are in the first instance and policy. How important is that growth narrative when you're out on the road? What are people telling you about the tariffs and the growth risk and the growth drag? I think that's one phrase that seems to have come up recently, which is about a growth drag in the world.
Yeah, the title of this panel is perhaps sets a different story than what we're looking at. The economy, at least the US economy, is an incredibly solid footing. You look at the balance sheets of banks, the non-financial corporates, households. We look at unemployment today. We are set up, particularly given some of the pro-growth policies that we have, to continue operating at this level. Sure, there's a lot of uncertainty, there's unpredictability. We may get some, some hiccups along the way. But when you think through some of the investments that companies are putting toward to work, we talked a lot about AI over the last day and a half or so. Those would require massive build-outs of data centers globally. You'll need to power those globally, and so. When we're thinking of, clients are thinking about making investments, this is not like trading in the stock market one day in, one day out. Mm-hmm. It really is about, business as usual. BAU is about long-term planning for growth.
What triggers a debt sustainability question mark in the bond market, and what is it that sort of would flash to you that we're moving towards questioning our debt trajectory, our fiscal position? What is it that flashes for you?
Well, I think that the credibility argument is a very good one. And if there is a credibility moment, look, there's a lot of risk in the world right now. I like to refer to this as a world of gray swans. But we've had black swans. And while I don't necessarily see one in the immediate future, a black swan event could be a trigger that would cause investors to stop buying sovereign wealth, sovereign debt, and so as a result, they'd stop participating. Right now, we are in equilibrium. there are enough non-U.S. investors as well as U.S. investors to purchase the U.S. debt and to participate and to continue to support the U.S. spending. But I have to say, if modern monetary theory is continued to be the discussion point in Washington, where you can continue to spend, increase the deficit and debt as long as you remain the reserve currency, I don't think that necessarily has long-term sustainability built around that theory. And so as a result, there could be a triggering event. I don't see one right now, but there could be where the ability to pay back that debt, which is part of the modern monetary theory, is to say, we don't have to pay it back. And I don't think that's realistic.
But I think also the aspect of an increasing public debt at the expense of private debt, so the crowding out of private credit, could be that triggering event. And what does that lead to? Ultimately, higher rates. And we saw what this creep up of rates has done post-COVID, which really has closed the markets for IPOs, particularly for those interest rate sensitive sectors, capital intensive sectors. When you're dealing with a higher rate environment, we really had seen dearth of technology IPOs. You looked at the private equity sector, which was incredibly active in the 2021 timeframe, was sitting on the sidelines, not deploying capital because the cost of financing, LBOs, became more onerous. To me, that is more of the derivative impact of an increasing public debt that would crowd out private debt and lead to higher interest rates.
I'll come back to that in a moment, because we were told that 2025 was going to be such an enormous year in terms of IPOs and in terms of a frenzy of activity. But Ankel, just weigh in here in terms of, what would flash red for you on the sustainability question, debt sustainability? So
to me, at the end, right, solvency is an issue, but you die of a liquidity crunch, right? And you die when there is a strike of buyers. And what can lead to a strike of buyers? One, to me, going back to the credibility story, is if we start questioning the independence of the Federal Reserve and monetary policy. And we know that there is going to be a new chair that is going to be appointed in a year's time and things like that. That is, for me, a focal point for investors, and that could create a buyer's strike. The other one, and it was also mentioned, is there is a lot of non-US buyers of US debt. And if we start questioning the ability or the willingness of the non-US buyers to continue to buy that debt, then again, we could have a problem.
This sort of takes us to a much, much bigger global issue. Every day on Bloomberg, we talk about the exorbitant privilege of the US's position financially, the exorbitant privilege of the dollar, the hegemony of this nation and its assets. We've got 4 years of what seems to be, if we keep going at the pace that we're going, it's going to be quite an exceptional pace of change. And at any level, is the exorbitant privilege or the hegemony of US assets challenged and risk of being challenged?
Well, there's always a risk of the challenge, but at this point in time, it's kind of like I don't really see an immediate black swan event. I also don't see an immediate risk to the strength of and the political power of the U.S. dollar relative to other currencies. We were momentarily challenged by the Chinese, who attempted to challenge that strength of the U.S. dollar as the global currency. And due to their problems economically, that has subsided. So for the current time being, I don't see there being a major risk. Now, like I said, in the future, that could definitely be challenged at some point in time, assuming that this trajectory that we're on doesn't change. I do actually, and maybe I should say something optimistic here, that I do actually see some change. I see the ability to be diverted away from this if the Trump administration and the current thinking is actually able to make a difference. But it's going to be a hard place to go without changing structurally the spending habits out of Washington, and that includes the non-discretionary spending in the U.S. And I would say the same thing for other economies around the globe, particularly Europe, where they're not going to be the challenger in any short term because they have structural problems that they have to solve for. And so I think the likelihood of there being an ascendant challenger is much more limited, again, in the near term.
Let me tighten the question up for you, Ankel. And you're right, Anne, I should have tightened it up a little bit, which is, it's not just a risk, but it's whether it's a tail risk which morphs into the middle of the bell curve at speed and at pace. What is it that could move the risk forward that you begin to see a serious challenge to those concepts of exorbitant privilege and hegemony?
So at the end of the day, the exorbitant privilege is predicated on the idea that the rest of the world wants to hold dollars. And they want to hold dollars, among other things, to buy things from the US, right? So if we end up in a world, and I'm not saying we are going there, where the level of tariffs and the level of barriers that are built around the US economy is very high, maybe countries will start thinking that, why do I need to hold so many dollars? And I don't think we are going to get there. I hope we are not going to get there, but complacency could take us there. So it's a risk.
Michal, for you, I know that your glass is a little bit more half full in some of these conversations, so I presume you're going to take a top up on this glass.
I would just say that the U.S. continues to be the destination of choice for capital and investments, but got to put on that, remember the mantra of only the paranoid survives, and so having that healthy paranoia and having that fiscal discipline has to be top of mind. And to me, it's a word about balancing. Yes, we're going to continue to grow, but where are we going to put dollars to work? And so balance is perhaps, or prioritization is the name of the game.
We're going to float one of the bigger sort of speculative stories that's in the markets today. By the way, I don't have a time monitor, so I'm not sure where I am on time, team, if they could just float this kite, which is, it's called the Mar-a-Lago Accord. And this is what's on the front page of Bloomberg today. It's about taking your creditors into a room for the United States of America and actually saying, you got to swap your treasuries for long-term debt. Now, this is radical. Nobody's saying that this is actually going to happen, but it's one of those kites that's flying out there. And how radical would that be and impact? Let's close off with this.
Well, I think it would be incredibly radical in a few ways. One, I don't think anybody's really taken a really creative approach to problem solving with regard to this debt. And what we're seeing out of the Trump administration in so many different parts is a very creative and new thought approach. Do I see this being feasible? I think it's going to be challenging for other investors and other sovereigns invested in U.S. Fixed income and the U.S. debt to want to take that trade. But I wouldn't put the administration past the opportunity to give it a go.
Briefly, Ankel, we're up against the clock here, so we're going to wrap up on this. Briefly on this kite that's flying out there today.
Well, when there are accords, I always think the same thing. Why hasn't it happened already, right? And obviously there is something that is missing. So my question to this kind of exercise is the following. What is going to be the price that you are going to offer on these long-term treasuries that is going to make it attractive? When there was the discussion about extending the maturity of the debt when we were at zero interest rates, one of the reasons why it didn't happen was that it was a less liquid part of the curve. It was going to be more expensive. So the question here is, imagine they say yes. What price, what yield are you willing to offer for this to be attractive?
Michal?
And why not treat perhaps government like a business, which is, I've talked about the record issuances before, where CFOs were acting prudently by pulling forward financings or refinancing at a lower rate environment. So to me, it's perhaps instilling some of that.
Okay, ladies and gentlemen, thank you very much for joining us today. That's Michal Katz, Ankel Dubire, and Anne Walsh of Guggenheim. Okay.